Are you thinking about investing in the Standard & Poor's 500 index? Before you do, let me tell you a few things that might save you from losing a lot of money. Here's the thing. Today, the Standard & Poor's 500 index looks less like a diversified basket and more like a collection of just a few giants. The 10 largest companies, including Nvidia, Microsoft, and Apple, make up nearly 40% of the index. That means your diversified investment is actually heavily dependent on just a handful of names. And when one sector, technology, makes up about 35% of the entire index, it's not really diversification, it's concentration. Let's talk about valuation, because that's where the danger really hides. When the Standard & Poor's 500 index trades around 22 times forward earnings, history tells us that future 10-year returns tend to fall close to zero, or even below it. It's like paying a premium price for something that's already been hyped up. The higher you pay today, the lower your potential tomorrow. And just a few days from now, on October 28th and 29th, the Federal Reserve will meet again. Markets are almost certain that the central bank will lower interest rates. Why? Because job numbers have softened, and growth is slowing. Lower rates can spark optimism and push stocks up in the short term. But remember, the Fed cuts rates when the economy is weakening, not when it's strong. That's something long-term investors can't ignore. The good news? Every time the Federal Reserve started cutting rates since 1993, the Standard & Poor's 500 index delivered positive returns most of the time. 6 months later, the median return was about 5%, and after a year, over 10%. So yes, history gives us a bit of hope. But hope is not a strategy. We need to stay smart about where we invest next. So, should you invest in the Standard & Poor's 500 index right now? It's been one of the best performing investments in history. But today, it's expensive, concentrated, and facing economic uncertainty. Lower interest rates might help for a while, but they can't fix valuation risk. That means you don't have to run away, but you do have to be smarter. Here's the smarter move. Diversify your portfolio. You can still hold the Standard & Poor's 500 index for your large cap exposure, but balance it with other themes. Add the Vanguard Russell 2000 Exchange-Traded Fund to capture small cap growth. Include the Schwab United States Dividend Equity Exchange-Traded Fund for stability and income. And consider the SPDR Gold Trust to protect against inflation and market stress. That's how you invest with confidence, not fear. If this helped you think differently, hit subscribe, and let's keep growing smarter together. Before we finish, remember, this video is not a recommendation to buy or sell any security. Everything shared here is for informational and educational purposes only. You should always do your own research, evaluate your financial situation, and, if needed, consult with a licensed professional before making investment decisions. Use this information as one of many tools to form your own conclusions, not as a final verdict.